Hello everyone, welcome to Dikshant classes. Today I am going to teach about the accrual concept. Here the question arises, what is accrual? The accrual principles is an accounting concept that requires transaction to be recorded when in the time period in which the transaction take place. Regardless of actual cash received, no matter whenever the cash received, but the transaction take place only when they occurred. The idea behind the accrual principle is that financial events are properly recognized by the matching the revenues against the expenses which transactions are happened, such as sale occur, rather than when the actual payment for the transaction may be received. Next is revenue accrual and deferrals. There are two bases, earned and earned. For the not received, it is accruals. The expense, the things are occurred when the transaction take places. And unearning is not impact. For the receiving part, it is deferred. It is happen in the future. When no matter it is transaction done today. Next is defer expenses. Defer means put the things until later. Therefore, defer expenses are those expenses whose recognition is put in the future, even though the payment has been made. It is a concept in which you have to pay cash now and the deferred expenses are recognized in the future. Next is accrued expenses. Accrued means grow or accumulated over the times. In accrual accounting, the matching principles criteria are met in the current period expenses will be need to be accrued in the current accounting period, and even if cash will not be paid until the later accounting period. You have to recognize the expenses now, but pay the cash later. Next is difference between now and later. The first basis is accrued revenue. Now, in the now sections, the revenue is recognized now, and the cash is received later. In the accrued expenses period, the expenses is recognized now and the cash is paid after future date. Deferred revenue is the revenue basis for the now is cash is received now and later on revenue is recognized. For the deferred expenses, cash is paid now and the expenses is recognized later on. Next is adjusting entries meaning. These are the journal entry which has to be made on the last day of the accounting period. The accounting period is the period if we start from 1st April 2026 and on 31st March 2027. This is an example of current accounting year. It may be changed for whatever the accounting period you considered. To ensure that accounts are in line with the accrual methods of the accounting and matching principle. Next is benefit. It helps the company to calculate the exact revenue, profit, loss, and updated financial statements to fix the error and calculate the exact expenses. Next, it is ensured that income statements only reports revenue or losses, expenses that is earned or incurred during the accounting period. Receivable and liabilities in the balance sheets represent true amount. Adjusting entries affected one real accountant and at least one nominal accountant. Further, it should be noted that not all entries that the company record at an accounting period are adjusting entries. Next is type of adjusting entries. Accrued revenues, accrued expenses, deferred expenses, depreciation expense, deferred revenue, doubtful accounts or bad debts. Next is accrued concept. It is classified into two parts. Paid but not you have to pay the expenses, but it is not incurred till date. The next part, classification is paid in advance. Prepaid expenses which are paid in advance. For example, we are paying the mobile recharge amount in advance. After that, you have to use the services of the particular company, Vodafone Idea. Assets are two things. First, under the prepaid expenses, first classification asset. Prepaid expenses debited because it debit the amount because we have to pay it in advance. Expenses account, expenses are paid, it is credited to the expenses account. Then liability, revenue accounted debited because you have to paid for that account. And earn account, which is not earned by the company, it is credited. The unearned revenue means which is not earned till date. It is classified into two parts: received in advance and received but not yet earned. Next is incurred but not yet paid. Expenses are incurred but not paid. Next is overdue. Next is accrued expenses. First classification is liability. Expenses accounts are debited because you have to pay for that expenses, so that it is debited. And because the rules apply, debit all the expenses, credit all the gains. Then accrued expenses is credited. Assets. Next is assets. Accrued revenue debited because you have to receive that amount, and revenue account is credited because revenue account is credited with that amount. Next is accrued revenue. The business is owed and earned but not yet received. Next is accounting period concept. Accounting period, a period which starts from the 1st April of each year and end on the next 31st March. For example, accounting year this start from 1st April 2026 and on 31st March 2027. It is a period of 12 months and the life period of the business is of the long span, which is classified into the operating periods which are smaller in duration. The accounting period may be either calendar year of January to December or the fiscal year of April to March. The operating periods are not equivalent among the trading firms. This means that operating period of one firm may be shorter than other one. According to the Companies Act 1956, the accounting period should not exceed 15 months. 1 year accounting starts from 1st January to 31st March. For the next fiscal year or financial starts from 1st April to 31st March of next year. Next is matching concepts. The matching concept is the concept in which we match the concept of whatever the expenses incurred by the company should be matched with the revenues in the particular years in accounting year. This concept only makes the entire accounting system meaningful to determine the volume of the earnings or losses the firm at the entry level of a transaction, which an outcome of the matching between the revenues. It must be necessary to the revenue expenses incurred by the company and the revenue must be matched in a particular period. The worth of transactions is identified through the matching of the revenues, which are mainly generated to the sales volume and the expenses level of entry firm. For example, the cost of goods sold and selling price of pen of ABC Limited 5 and 10 respectively. The firm produced 100 ball pens during the first shift, and out of 100 pen manufactured, 20 pen are considered to damage, which cannot be supplied to customers rejected by the quality circle department. So conclusion is that only 80 pens are meet the quality criteria. So why the company should be supply 20? It should be make loss. It may reputation will be loss of the company. So it impact on their business. There was an order from the firm XYZ Limited which amounted to 80 pens to be supplied immediately. The worth of the transactions of the firm at every level of the transaction is being steady only through the matching of the revenue with the expenses. That's all today's class. If you have any doubt, any query, you should comment it in comment section. I will surely make video. Thank you so much for listening carefully.